Preparing for a finance manager at Centrica interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a finance manager at Centrica? Centrica appeals to me because finance has a direct role in balancing customer value, operational performance, energy volatility, and the transition to lower carbon solutions. I want to lead a team that produces reliable reporting while challenging decisions constructively. My experience combines strong controls, forecasting, and business partnering, so I can move beyond explaining variances to influencing outcomes. The opportunity is especially attractive because disciplined capital allocation and customer-focused execution are central to Centrica's long-term performance. While answering, connect your motivation to Centrica's energy, services, customer, and net zero agenda. Demonstrate commercial curiosity, leadership ambition, and an understanding of how finance supports resilience, investment, affordability, and sustainable growth. Question 2. What do you understand about Centrica's business and its main financial drivers? I understand Centrica as an energy and services group with customer-facing operations, including British Gas, alongside energy-related activities and growing solutions supporting the transition. Key drivers include customer numbers, consumption, tariffs, bad debt, weather, commodity costs, regulatory requirements, operating efficiency, and service productivity. I would also monitor cash conversion, working capital, capital expenditure, and returns on investment. Understanding those drivers helps finance explain performance rather than simply report historical numbers. Make sure to cover Centrica's customer-facing energy and services activities, earnings sensitivity to volumes, margins, commodity prices, regulation, weather, customer behavior, costs, capital investment, and the importance of cash generation. Question 3. How would you build an effective monthly management reporting pack? I would start by clarifying the decisions the pack must support, then agree a controlled timetable, standard definitions, and clear ownership. The pack would show actuals, budget, forecast, prior year, key operational drivers, cash, risks, and actions. I would focus commentary on causes and implications, not merely movements. Before distribution, I would complete reconciliations and review unusual items. Finally, I would track agreed actions so reporting leads to performance improvement rather than becoming a static monthly exercise. In your answer, talk about accuracy, timeliness, agreed definitions, executive relevance, actual versus budget analysis, drivers, risks, actions, cash, operational metrics, concise commentary, and follow-up ownership. Question 4. How do you explain a significant variance to a non-finance stakeholder? I would avoid leading with accounting terminology and first explain the business impact. For example, if gross margin is below plan, I would separate customer volume, pricing, commodity cost, mix, timing, and exceptional items. I would quantify each driver, validate the explanation with the operational owner, and distinguish temporary effects from structural issues. Then I would agree actions, owners, and forecast implications. The goal is a shared understanding that supports a better decision, not a defensive debate. Be sure to mention translating accounting outcomes into operational drivers, separating volume, price, mix, timing, and one-off effects, quantifying impact, remaining objective, and agreeing practical corrective actions. Question 5. Describe your approach to budgeting and forecasting in a volatile energy environment. I would use a driver-based model rather than relying solely on prior year percentages. Important assumptions would include customer numbers, consumption, weather, commodity prices, tariffs, service volumes, headcount, regulation, and working capital. I would prepare base, upside, downside, and severe scenarios, showing sensitivities clearly. Forecasts should be refreshed using current operational evidence and reviewed with accountable owners. I would also compare previous forecasts with outcomes to identify bias and improve the planning process. Focus on driver-based planning, scenario analysis, commodity and weather sensitivities, customer behavior, regulatory assumptions, rolling forecasts, ownership, forecast bias, and transparent communication of uncertainty. Question 6. Tell me about a time you improved a finance process. In a previous role, month-end reporting depended on manually consolidating several inconsistent spreadsheets, creating delays and review risk. I mapped the process, removed duplicated steps, introduced standard templates, and automated reconciliations using controlled data extracts. I involved preparers and reviewers early, documented responsibilities, and monitored the first 3 cycles closely. Close reporting became 2 days faster, review points reduced materially, and commentary improved because the team spent more time analyzing drivers instead of assembling data. Make sure to structure the example using situation, action, and result. Quantify time, quality, or control improvements, explain stakeholder involvement, and show how the change was embedded and sustained. Question 7. How would you ensure strong financial controls across a complex business area? I would begin with the material financial and operational risks, then map key controls to those risks and relevant reporting assertions. Controls should include appropriate approval limits, segregation of duties, reconciliations, system access reviews, journal governance, and documented evidence. I would test whether controls operate consistently, investigate exceptions, and assign remediation owners with deadlines. Where possible, I would automate preventative checks. Strong controls should be practical and proportionate, protecting reporting quality without creating unnecessary bureaucracy. In your answer, cover risk assessment, segregation of duties, reconciliations, access controls, journal review, evidence, policy compliance, control testing, remediation, automation, and proportionate governance. Question 8. How do you manage a challenging month-end close? I manage a difficult close by identifying critical path tasks early and assigning clear owners and deadlines. I prioritize material balances, cash, revenue, provisions, intercompany items, and key reconciliations, while escalating blockers quickly. I use a visible close tracker and hold short check-ins rather than waiting for missed deadlines. Quality cannot be sacrificed for speed, so review evidence remains mandatory. After close, I analyze root causes and improve the timetable, data, or controls causing recurring pressure. Be sure to mention early planning, critical path activities, ownership, materiality, accruals, reconciliations, escalation, quality review, communication, and learning from recurring close issues. Question 9. What would you consider when accounting for revenue in an energy and services business? I would first understand the contract and identify each performance obligation, such as energy supply, installation, maintenance, or other services. Revenue recognition should reflect when control transfers or the service is delivered. For supplied energy, reliable consumption data, estimation methodology, meter reads, tariff changes, and accrued or unbilled revenue are critical. I would review contract modifications and variable consideration carefully, ensure assumptions are supported, and confirm reconciliations between operational systems, billing, and the general ledger. Focus on identifying performance obligations, customer contracts, consumption estimates, meter data, accrued and unbilled revenue, timing, principal versus agent considerations, contract modifications, and International Financial Reporting Standards 15 control evidence. Question 10. How would you assess provisions and expected credit losses for customer balances? I would segment receivables by customer type, aging, payment behavior, vulnerability, and relevant risk characteristics. Historical collection patterns provide a starting point, but I would incorporate current economic conditions, affordability pressures, regulatory developments, and recovery performance. I would challenge whether write-offs and cash receipts support the model, review overlays and sensitivities, and ensure assumptions are approved and documented. I would also connect the accounting assessment with operational collections initiatives and customer support policies. In your answer, cover historical loss experience, aging, payment behavior, macroeconomic conditions, customer segmentation, regulatory factors, forward-looking assumptions, sensitivity analysis, governance, and data quality. Question 11. How do you evaluate a capital investment proposal? I would assess the proposal against strategic objectives and focus on incremental after-tax cash flows, not allocated accounting costs. The analysis would include NPV, IRR, payback, capital requirements, operating costs, working capital, residual value, and implementation risk. I would test sensitivities such as customer adoption, energy prices, timing, cost inflation, and regulatory changes. I would also define approval gates and post-investment measures, ensuring the organization learns whether forecast benefits and returns were actually achieved. Make sure to cover strategic fit, incremental cash flows, NPV, IRR, payback, sensitivities, scenario risks, operating benefits, implementation costs, regulatory context, option value, and post-investment review. Question 12. How would you manage working capital and cash forecasting? I would build a short-term cash forecast from operational drivers, including collections, customer billing, supplier payments, payroll, tax, commodity settlements, capital expenditure, and financing flows. I would reconcile forecast movements to actual cash and investigate variances promptly. Working capital opportunities might include improving billing accuracy, reducing unbilled balances, managing supplier terms, and accelerating dispute resolution. I would maintain downside scenarios and escalate liquidity risks early, working closely with treasury, commercial teams, and operational owners. Discuss collections, customer deposits, supplier terms, inventory, settlement timing, accruals, billing accuracy, cash conversion, scenario forecasting, liquidity risks, and close collaboration with treasury and operations. Question 13. What is your approach to business partnering with operational leaders? Effective partnering begins with understanding how the operation creates value and what decisions leaders face. I build credibility by being accurate, responsive, and willing to understand the detail, then challenge assumptions constructively using evidence. I translate financial outcomes into operational measures and agree a small number of meaningful KPIs. If I disagree with a proposal, I explain the risk and alternatives clearly rather than simply saying no. The relationship should improve decisions while preserving finance's objectivity. Focus on credibility, curiosity, listening, commercial challenge, simple communication, shared KPIs, decision support, accountability, and maintaining independence when financial evidence contradicts stakeholder preferences. Question 14. Tell me about a time you challenged a senior stakeholder. A senior stakeholder once wanted to include optimistic cost savings in a forecast before implementation evidence existed. I first understood the commercial rationale, then analyzed comparable initiatives, timing, dependencies, and downside risk. I presented a base case using only supported savings and a separate upside scenario tied to milestones. The stakeholder accepted the approach because it preserved ambition without overstating certainty. We later tracked delivery against those milestones, improving forecast credibility and strengthening our working relationship. Be sure to describe respectful challenge, evidence, materiality, alternatives, listening, escalation when necessary, the eventual decision, and the measurable outcome or lesson learned. Question 15. How would you investigate a revenue or margin fluctuation that does not make sense? I would begin by confirming the movement is real through reconciliations between the general ledger, billing, operational volumes, and management reports. I would decompose the variance into price, volume, mix, timing, estimates, foreign exchange, and one-off items. Then I would inspect cutoff, system interfaces, manual journals, tariff changes, and unusual customer or contract activity. I would involve data and operational owners, document the root cause, correct the accounting if needed, and strengthen the control preventing recurrence. In your answer, cover data lineage, reconciliations, operational volumes, price and mix, timing, estimates, system interfaces, manual journals, cutoff, unusual customers, and root cause remediation. Question 16. How do you prioritize competing deadlines and requests? I prioritize according to risk, materiality, deadline, stakeholder impact, and dependencies. Statutory, control, liquidity, and customer impacting matters usually take precedence over lower value analysis. I clarify the required outcome and level of precision, then sequence work visibly and delegate where appropriate. If capacity is insufficient, I explain the trade-offs early and agree revised priorities with stakeholders. I protect critical review steps because delivering quickly is not successful if the result is inaccurate or poorly controlled. Mention business impact, regulatory and reporting deadlines, materiality, dependencies, available capacity, transparent trade-offs, delegation, escalation, and maintaining quality under pressure. Question 17. What financial risks are particularly relevant to an energy company? Relevant risks include commodity price and volume exposure, weather-driven demand changes, customer credit and affordability, liquidity, counterparty failure, regulatory intervention, cyber incidents, operational outages, and inaccurate forecasts. These risks interact. For example, weather and commodity movements can affect margins and cash simultaneously. I would assess probability and impact, identify mitigating controls, monitor leading indicators, and maintain scenarios. Finance should provide transparent information for decisions while working with risk, treasury, operations, and commercial teams on mitigation. Focus on commodity price and volume risk, weather, credit, liquidity, regulation, cyber, operational resilience, customer affordability, forecasting, counterparty exposure, and the interaction between risks. Question 18. How would you support accounting for derivatives or commodity hedging? I would first understand the economic purpose, instrument terms, exposure being hedged, and Treasury's risk management strategy. Then I would verify confirmations, independent valuations, valuation inputs, settlement data, and reconciliations. If hedge accounting is applied, documentation, designation, effectiveness assessment, and treatment of gains or losses under International Financial Reporting Standards 9 must be robust. I would involve technical accounting and treasury early, because accurate accounting depends on the commercial strategy, systems, controls, and evidence supporting the relationship. In your answer, mention understanding the commercial hedge, instrument terms, valuation, confirmations, effectiveness, hedge documentation, International Financial Reporting Standards 9 treatment, controls, disclosures, and collaboration with Treasury. Question 19. How do you manage audit requests and maintain a strong relationship with external auditors? I would prepare by identifying significant risks, judgments, reconciliations, and supporting evidence before the audit begins. I would maintain a request tracker with owners, deadlines, status, and quality checks, ensuring responses are complete rather than simply fast. I would discuss complex matters early and be transparent about uncertainties or control gaps. If auditors challenge an area, I would evaluate the evidence objectively and resolve differences through facts. Afterward, I would convert findings into practical remediation actions. Be sure to cover preparation, audit evidence, clear ownership, technical transparency, timeliness, challenge, issue logs, independence, remediation, and avoiding surprises late in the audit. Question 20. How would you assess an accounting judgment or unusual transaction? I would start with the transaction's commercial substance and identify the applicable accounting guidance, relevant interpretations, and materiality. I would document the facts, alternatives considered, assumptions, evidence, and conclusion, distinguishing accounting policy from estimation uncertainty. For complex or material matters, I would obtain technical accounting input and discuss the proposed treatment with auditors early. I would also assess disclosure, control implications, and whether the conclusion should be revisited as facts or contracts change. Discuss understanding substance, applicable International Financial Reporting Standards guidance, materiality, alternatives, evidence, assumptions, internal technical review, auditor engagement, documentation, and consistent treatment in future periods. Question 21. Describe your leadership style and how you develop a finance team. My leadership style is clear, supportive, and accountable. I set expectations around quality, deadlines, and stakeholder service, then give people ownership rather than controlling every task. I use regular one-to-ones to coach technical skills, commercial thinking, and communication, with feedback that is specific and timely. I adapt support to experience levels and create opportunities to present directly to stakeholders. A strong team should deliver dependable work today while building capability and succession for tomorrow. Focus on clarity, trust, coaching, delegation, technical development, feedback, psychological safety, performance expectations, succession, inclusion, and adapting leadership to individual capability. Question 22. How would you handle an underperforming team member? I would address the issue promptly and privately, using specific examples rather than assumptions. I would listen first to understand whether the cause is capability, workload, clarity, confidence, or circumstances. Then I would agree measurable expectations, support such as training or coaching, and review dates. I would document the plan and provide consistent feedback. If performance did not improve despite reasonable support, I would follow the appropriate formal process fairly and in partnership with our. Mention diagnosing the cause, clear expectations, objective evidence, supportive conversation, agreed improvement plan, training, regular checkpoints, documentation, fairness, and formal escalation when necessary. Question 23. What would you do if you discovered a material reporting error shortly before a deadline? I would first confirm the error, quantify its gross and net impact, and assess affected statements, KPIs, controls, and stakeholders. I would immediately inform the relevant finance leader and agree whether correction, disclosure, or further investigation is required. I would preserve evidence and avoid concealing the issue to meet a deadline. After resolving the immediate reporting risk, I would identify the root cause, implement a control improvement, and communicate lessons without assigning blame prematurely. In your answer, cover quantification, containment, escalation, materiality, correction, disclosure, root cause, evidence, stakeholder communication, and maintaining integrity despite deadline pressure. Question 24. How would you use data and automation to improve finance performance? I would target repetitive, rules-based activities with high volume or error risk, such as reconciliations, data validation, variance analysis, and reporting consolidation. Before automating, I would map the process, fix data definitions, and confirm ownership and access controls. I would introduce exception-based review rather than removing judgment entirely. Success measures could include shorter close time, fewer manual adjustments, improved accuracy, and more analysis capacity. I would pilot the change, gather user feedback, and scale only after controls operate reliably. Be sure to mention data quality, process mapping, repetitive tasks, automated reconciliations, dashboards, exception reporting, access controls, user adoption, measurable benefits, and retaining appropriate human review. Question 25. What would your priorities be during your first 90 days at Centrica? In the first 30 days, I would listen, understand Centrica's strategy, key performance drivers, reporting calendar, systems, risks, and stakeholder expectations. During the next month, I would review controls, forecast assumptions, recurring close issues, and team capability, while identifying practical quick wins. By day 90, I would present a prioritized roadmap linking improvements to accuracy, efficiency, cash, and decision support. I would avoid changing processes prematurely. Credibility comes from understanding the business first. Focus on listening, understanding strategy and performance drivers, meeting stakeholders, reviewing controls and reporting, identifying quick wins, learning systems, building trust, and creating a prioritized improvement roadmap. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.